What happens to depreciation losses if an investor is using a retirement account, such as an IRA or a solo 401k?
They're still there. They're just not available to be utilized to offset other outside income. So, I mean, again, that is a taxpayer. So it's considered a trust. An IRA is considered its own individual taxpayer. It has tax if there's UBIT or unrelated business income tax that is triggered by debt. So on a piece of real estate, if you have debt, income related to that debt is taxable. And so there is the opportunity to basically be able to do the same thing that we're doing outside of a retirement account inside the retirement account. So there's misnomer that IRAs don't need depreciation and IRAs don't need, to use bonus depreciation. But there's an opportunity if you've got a large sale and you're going to pay UBIT tax, which is 37%. It's the largest tax out there, and it goes from 0 to 100 after $12,500 of income. So if you have more than $12,500 of UBIT income, you're paying tax at 37%. So ultimately, you want to be able to reduce that as much as possible. So the use of depreciation and things of that nature do fall into it. Now, depreciation within a trust, they don't have the access of bonus. They have to use straight line, but depreciation is utilized within an IRA account.
Got it. Very interesting. So let's say you invest $200,000 into a deal through a self-directed IRA, and you get $100,000 in depreciation losses year one. And maybe the following year, you have $25,000 of income on the K1. You're able to offset that so you don't have to pay the UBIT by using that depreciation loss that you saw year one of ownership that carried forward, correct?
You would ultimately have to memorialize that. So one of the things that doesn't happen a lot is people don't file tax returns for IRAs. They're 990Ts is what they're called. So as long as you're following and you're filing, then you can utilize that to offset other income. But yes, essentially, it remains the same. The character is the same within that taxpayer. Like I said, it's an individual taxpayer, so it's just getting flow through income or losses that it's going to treat within its own tax return accordingly.
What's the difference in between a self-directed IRA and a solo 401k?
Different tax codes. So a self-directed IRA is under 403. Anything that is outside of 401k is subject to UDFI, which is unrelated debt financed income. So ultimately, if you have a gain, you're an LP in one of your deals that's financed 80%, let's just say, and you throw off $1 million of gain. Well, 80% of that gain came from debt. So 80% of that gain is going to be subject to UBIT tax because of UDFI. If that was in a 401k, that wouldn't be the case because 401ks aren't subject to UDFI. So the difference there is in that situation, a 401 is no tax. An IRA is taxed at 37% on 80% of that gain.
Got it. And in order to set up a solo 401k, that's essentially a 401k for a business, correct? So you have to operate some sort of business.
Correct. That's the big caveat is a 401k is owned by the business and an IRA is an individual retirement arrangement. So it's individual.